In 2022, the Federal Reserve raised interest rates faster than at any point in 40 years. Gold was supposed to collapse. Every model said so. It didn't collapse, it went up, and it has kept going up through an interest rate environment that, by every rule that worked since 1980, should have crushed it. Something has changed about gold that almost nobody in finance is naming clearly. Not the price, the behavior. The asset has stopped responding to the inputs it used to respond to and started responding to something else. This video is about what that something else is and why it changes the case for owning gold in a way that has nothing to do with the arguments you've heard before. If you're new here, I don't predict prices. I'm not going to tell you gold is going to $10,000. What I'm going to tell you is that the model investors have used to think about gold for 2 generations stopped working 3 years ago. And the new model implies something specific about portfolios that almost nobody is acting on yet. Here's the relationship that broke her. From the early 1980s through 2021, gold did one thing. When real interest rates rose, gold fell. When real rates fell, gold rose. The two lines on a chart mirrored each other so precisely that you could explain gold's price in any given month with two inputs and almost nothing else. The logic was simple. Gold pays no interest. When other assets pay more, holding gold costs you. When other assets pay less, holding gold costs you less. The opportunity cost set the price. That model worked for 40 years. Then in 2022, real rates went from deeply negative to solidly positive in 18 months, faster than any move in modern history. By the old model, gold should have fallen 40%. It went sideways, then it went up, then it broke to new all-time highs while real rates stayed elevated. This is not a small anomaly. This is the central pricing model for an entire asset class failing in real time. Markets didn't break, the model did. And the response from most of finance has been to either ignore it or to invent stories that don't quite fit. Let me tell you the story that does fit. The marginal buyer of gold changed. When the buyer changes, the logic of the price changes with it. For 40 years, the buyer who set the price of gold at the margin was the Western financial investor, hedge funds, macro traders, ETF flows. These buyers ran a real rate model because that's what their training told them to do. When real rates rose, they sold. When real rates fell, they bought. Their behavior produced the correlation. And the correlation produced the model that explained their behavior. Starting in 2022, a different buyer showed up, and that buyer doesn't care about real rates at all. Central banks, specifically central banks in emerging markets, China, India, Turkey, Poland, Singapore, and a long list of others started buying gold at a pace not seen since the end of Bretton Woods. The numbers are public, and they are not subtle. Central bank gold purchases in 2022 were the highest on record at over 1,000 tons. 2023 was the second highest. 2024 came in higher still. 3 consecutive years of buying at a level the world hadn't seen in 50 years. And the buying isn't evenly distributed. The People's Bank of China reported gold purchases in 18 consecutive months between late 2022 and early 2024, the longest sustained accumulation in its modern history. Turkey's central bank added more gold to its reserves in 2023 than in the previous 5 years combined. Poland's central bank publicly stated a target of holding 20% of its reserves in gold and bought aggressively to hit it. These aren't speculative trades. These are sovereign institutions changing the composition of their reserves on purpose and changing it in the same direction at the same time. They do not run a real rate model. They run a counterparty risk model. Gold didn't become irrational. The incentives behind it changed. And those two models respond to completely different inputs. Here's why the model changed. In February 2022, the United States and its allies froze approximately $300 billion of Russian central bank reserves held in dollar-denominated assets. Whether that policy was justified is not the subject of this video, and I'm not going to argue it. What matters for understanding gold is the signal that decision sent to every other central bank in the world. The signal was this: dollar reserves are conditional. They can be frozen. The asset that central banks had spent 2 generations treating as the safest asset on Earth turned out to have a counterparty, and that counterparty could change the rules. Gold has no counterparty. Gold sitting in your own vault cannot be frozen by a decision made in Washington or Brussels. The honest historical note is that central banks had been net buyers of gold since around 2009 after 2 decades of net selling, so February 2022 didn't start the trend, it accelerated it. The annual buying pace roughly doubled in the 2 years after the reserve freeze compared to the decade before it. And the geographic mix shifted, with the buyers who accelerated most being the central banks with the most reason to worry about dollar-based sanctions risk. That's the pattern. Pre-existing trend, sharp acceleration after a specific policy event, geographic distribution that matches the obvious motive. The case for calling it a regime change rather than a continuation rests on that combination. If this is right, then most portfolios are positioned for a version of the financial system that no longer exists. And that's not a small mistake, that's a structural one. This is the structural change. The marginal buyer of gold is no longer a hedge fund running a real rate model. The marginal buyer is a sovereign institution running a counterparty risk model. The asset is the same, the buyer is different. And because the buyer is different, the inputs that move the price are different. Which means the old model for gold doesn't need a tweak, it needs replacement. Let me make the implications concrete, because this is where the argument starts to matter for your portfolio. Implication 1. Gold's correlation with real rates is probably not coming back, not because real rates have stopped mattering, but because the buyer who cared about them is no longer setting the price. As long as central bank demand stays elevated, the old correlation stays broken. Implication 2. Gold's correlation with the dollar is also weakening. Central banks buying gold are often doing it as part of a deliberate strategy to reduce dollar exposure. They aren't waiting for the dollar to weaken before they buy. They're buying because they want less dollar exposure regardless of where the dollar trades. Implication 3 is harder to be confident about, and I want to flag that before I make it. Gold's behavior in a crisis is now harder to predict. Historically, gold rose in crises because Western investors fled to it, but Western investors aren't the marginal buyer right now. If the next crisis triggers a flight to dollars by Western investors, that no longer automatically means gold falls because the central bank bid underneath the market is structural rather than tactical. I'm less sure about this one than the first two because we haven't had a real crisis under the new regime yet. The first two implications follow logically from the structure. The third is a hypothesis about how the new structure interacts with a stress event we haven't seen. Treat it as a possibility worth considering, not a conclusion to bet on. So, what does this mean for an investor? It means the asset you may have ignored for the last decade because you thought you understood it has become an asset you should reconsider. Precisely because the thing you thought you understood is no longer true. The case for owning gold used to depend on a view about real rates and the dollar. It now depends on a different question entirely, whether the shift in who buys gold is durable and whether the conditions that created the shift are durable. My honest read is that both are. The freezing of Russian reserves cannot be unfrozen as a precedent. Every central bank in the world now knows that dollar reserves carry a kind of political risk they didn't previously price. That knowledge doesn't go away when the news cycle moves on, it compounds. Which means the central bank bid under gold is probably not a 2022 to 2024 phenomenon, it's probably a regime. Now the practical question. How do you get exposure to gold in a world where the asset has stopped behaving the way it used to? The vehicle landscape looks similar to the silver landscape I walked through last video. The trade-offs are different in ways that matter. Path 1. Physical gold. The case for physical gold has actually gotten stronger over the last 3 years, and not for the reasons the basement coin channels usually give. The case is structural. If the reason gold's price has changed is that counterparty risk on financial assets has been revealed as real, then the form of gold with the lowest counterparty risk has become more valuable relative to the forms with higher counterparty risk. That's just internally consistent. The costs are the same as silver. Spreads, storage, illiquidity, but gold is much denser. $100,000 of gold weighs about 3 pounds. $100,000 of silver weighs about 200. The practical case for physical gold is meaningfully easier than the practical case for physical silver. For investors who want a real allocation to physical, gold is the more practical metal. The opposite is true if your concern is system failure at the consumer level, because silver's lower unit value makes it more useful as a transactional metal. Different scenarios, different metals. Path 2. Gold ETFs. The two largest are GLD and IAU. There's also GLDM, a lower-cost version of GLD designed for long-term holders. GLD charges 0.40% per year. IAU charges 0.25%. GLDM charges 0.10%. For a long-term hold, GLDM is the cleanest choice. For active trading, GLD has more liquidity. The audit point I made about silver ETFs applies here. The gold is real, the bars are numbered, the lists are public. Whether owning a claim on a trust that owns gold is the same as owning gold is a question only you can answer based on what you're actually planning for. One variation worth knowing, Sprott's Fizz holds physical gold in Canadian vaults outside the U.S. custodial system and allows physical redemption above a certain threshold. It costs more than GLDM. If your specific concern is jurisdictional rather than counterparty, PIS is the vehicle designed for that concern. If your concern isn't jurisdictional, GLDM is cleaner. Path 3. Gold mining stocks. This is the path that has performed worst over the last decade, and where I'm going to give you the most honest take I can. The theory is the leverage argument I made about silver miners. A gold company with all-in costs of $1,500 per ounce makes a small profit when gold is at $1,600 and a large profit when gold is at $2,400. The metal moves 50%, the profit per ounce moves several hundred%. That's the theory. The practice over the last decade has been different. Gold miners have systematically underperformed the metal, even during periods when the metal rose significantly. The reasons are specific: cost inflation, capital discipline failures, jurisdictional risk in mining regions, and dilution from poorly timed equity raises. The honest read is that the sector as a whole has not earned its leverage. Individual companies have, the sector has not. The two largest ETFs are GDX, which holds established miners, and GDXJ, which holds smaller ones. GDXJ has more leverage in both directions and a worse long-run track record. For investors who want leveraged exposure and accept the historical underperformance, GDX is the more defensible choice. For investors who want to own the metal without taking on operational risk, the ETFs in Path 2 are the cleaner expression. My honest view is that for most investors who want gold exposure, the miners are not the right vehicle. The structural argument for leverage is real. The sector has not delivered on it in practice, and there's no obvious reason to believe the next decade will be different from the last. So here's the summary. GLDM for low-cost long-term exposure. Fee-wise if your concern is jurisdictional. Physical if your concern is counterparty risk all the way down. GDX only if you specifically want mining leverage and accept the sector's track record. For most portfolio-oriented investors who want gold exposure, GLDM is the starting point. Everything else is a variation built for a specific reason. Let me bring this back to the structural argument, because the vehicle conversation is downstream of it. The reason gold is worth examining right now is not that the price has gone up. Prices go up and prices go down. The reason gold is worth examining is that the model investors have used to price it for 40 years stopped working. And the new model implies a different role for the asset in a portfolio. Under the old model, gold was a real rate hedge. You owned it when real rates were falling. You sold it when they were rising. Under the new model, gold is something else. It's a hedge against the risk that the assets you thought were safe turn out to have political conditions attached to them. That risk didn't exist meaningfully for Western investors for most of the last 40 years. It exists now, and it's structural, not cyclical. The question isn't whether gold is going up. The question is whether a portfolio built for a world where dollar-denominated assets had no counterparty risk is the right portfolio for a world where they demonstrably do. For a lot of you, the honest answer is no, and a modest allocation to gold is one piece of how you fix it. Two quick things before I close. In the comments, tell me if you already own gold and what convinced you. And if you think I'm wrong about the regime change, tell me where, specifically. I argue back. Next video is platinum, and the structural setup for platinum is, in some ways, more interesting than either gold or silver, and almost nobody is examining it. Subscribe so you don't miss it. One last thing. The asset didn't change. The world around the asset changed. Gold is just responding to the world it's actually in, not the world the model assumed. That's the story of more than gold. That's the story of most of what's about to come.